Hello everyone, welcome back to the Learning Through Thalaivarave channel. So we are currently into Conquering Economy series, and a series of lectures has been put into YouTube channel explaining different concepts of economy to get relevant to the concepts for mains as well as prelims examination. So in this lecture we will be currently concentrating on taxation. Okay, so today's lecture will be 15th lecture. So on the number it will be 14th lecture. It is very much relevant for prelims as well as mains, as because questions have been asked in this aspect, in particularly from the taxes in previous years as well. So let's get into the lecture. See, taxes are compulsory financial charges levied by a government on the individuals or entities to fund the public expenditure. See, they are particularly or broadly categorized into direct and indirect taxes. Direct taxes includes income tax, corporate tax, wealth tax if applicable. However, wealth tax has been abolished since 2015, so this does not come into account. Income tax and corporation tax are aspects of direct taxes, while indirect taxes are goods and service taxes, GST, customs duty. So this part belongs to indirect taxes. So the taxes are compulsory financial charges levied by a government on individuals or entities. That is, it is put on an individual or a company to fund the public expenditure. So that's how taxation works into play. So now we look about the different types of taxation. So what is the different types of taxation? These terms describe how the burden or tax burden is distributed across different income groups. First one is progressive taxation, a tax system where the tax rate increases as the taxable amount or income or wealth. If they increase, the tax you pay also increases. It aims to reduce income inequality and achieve social equity by redistributing wealth. See, income tax in India is progressive tax with different tax slabs and higher rates for high income brackets. Regressive taxation, a tax system where the tax rate decreases as the taxable amount increases. See, in effect, lower income individuals pay a larger percentage of their income in taxes than the higher income individuals, often considered inequitable as it exacerbates the income disparities. See, income in indirect taxes like GST can be considered regressive in nature because everyone, regardless of their nature or income, pays the same tax rate on a particular good or a service. Next one is proportional tax, a tax system where the tax rate is fixed regardless of the taxable amount. Everyone here pays the same percentage of their income taxes. It is simplified and pursued fairness as everyone contributes equally. However, it can still disproportionately affect the lower income groups as the fixed percentage represents a larger portion of the disposable income. Like, let's say, if a country had a flat income tax for 10% of everyone, regardless of income, while no major tax in India is purely proportional, some cesses or charges might appear proportional on the base tax amount. So these three types are the different types of taxation methods. Now, what is tax buoyancy? See, it is the measure of the responsiveness of the tax revenue growth, that is, tax growth of the tax revenue, to the changes in the nominal gross domestic product. So what it comes to say is, it reflects the elasticity of the tax system and the impact of the discretionary policy changes. Let's say if tax buoyancy is greater than 1, then tax revenue grows faster than the GDP, which brings to the aspect that the nation is having efficient tax system. Same if the tax buoyancy is lesser than 1, tax revenue grows slower than GDP. So it indicates inefficient tax based system, inefficient tax based system. Say example, if nominal GDP grew by 10% and tax revenue grew by 12%, tax buoyancy would be 1.2. So it shows a positive, tax revenue grows faster. It's a positive aspect. A high tax buoyancy is desirable as it indicates that the government's revenue automatically increases with the economic growth, which provides more resources for public spending without needing to raise the tax frequently. This is tax buoyancy. That is, it measures the responsiveness of the tax growth to the changes in the nominal gross domestic product. So this is one concept which we must know. Another concept is tax elasticity. It measures the responsiveness of tax revenue growth to changes in the tax base, assuming no changes in tax rates or tax laws. Like, it reflects the inherent responsiveness of the tax structure. Let's say if tax elasticity here is greater than 1, then tax revenue grows more proportionately to the tax base. If tax elasticity is lesser than 1, here tax revenue grows slowly or grows less proportionately than the tax base. So you might get confused. What is elasticity? What is buoyancy? See, tax elasticity is a more of a pure measure which isolates the effect of economic growth on revenue, while buoyancy also includes the impact of policy changes. See, tax elasticity does not assume the changes in tax rates, but tax buoyancy includes the changes in tax rates or tax laws and brings the change and brings the factor. That is the difference. Here tax elasticity has no change in tax rates, the tax buoyancy takes tax rates into consideration. That is the change. So now, moving on further with the lecture, we will be looking about the administration of tax. First one, central government. Under the central government, the Ministry of Finance, which is the apex body responsible for formulating tax policy, legislation and administration. Under the Ministry of Finance comes the Department of Revenue, where under the it's responsible for all matters related to direct and indirect union taxes. And along with that comes CBTD, which is Central Board of Direct Taxes, which formulates policies relating to direct taxes, supervises the collection of direct taxes and administers various direct tax laws, example income tax. Another one is Central Board of Indirect Taxes and Customs. It formulates policies related to indirect taxes, GST, customs, and supervises their collection and administers their relevant laws. Moving on to that comes the Enforcement Directorate. It investigates the economic crimes, including those related to tax evasion, money laundering under the Prevention of Money Laundering Act, and finally comes the Directorate General of GST Intelligence, which is the intelligence arm of CBIC, responsible for collecting intelligence and conducting investigations related to GST evasion. However, when it comes to state government, the state finance departments are responsible for formulating state-specific tax policies, such as setting the state GST rates in consultation with the state GST Council, and the state's goods and services tax departments administer the SGST laws, collect SGST, and conduct enforcement within their respective states. So moving on with that, we'll be looking into the challenges in tax administration, tax evasion and black money. See, a persistent challenge leading to revenue loss. When you pay the taxes properly, it eventually pushes your economic growth. Okay, but if you try to evade tax and keep it as black money, that is without accounting for it, eventually it might bring for your personal growth at the same time you are doing injustice to the country, injustice to the people who are properly paying the tax. That is tax evasion. Litigation, high number of tax disputes leading to delays and administrative burden. There are a lot of delays, administrative burden due to improper tax disputes or high number of tax disputes. Complexity of laws. Despite reforms, tax laws are still complex, especially for the small businesses in India in particular, because of which the tax evasion also still lies higher. Next one is capacity building. Ensuring adequate training and resources for tax officers is very need of the hour. So when this is done properly, capacity building is done properly, eventually it pushes more and more people towards the capacity building, and proper tax reforms would be brought in, and proper tax paying could come from the people. Next one is adapting to the digital economy. Taxing digital services, e-commerce, and cross-border transactions effectively can bring in a change to the taxation policy, making it more worth of paying, or making it more convenient to pay the taxes. And let's look into the goods and services tax. So this is something which we must know, because after the introduction of GST, it has become one of the most important taxes which comes into play apart from income tax or corporation tax. So it is better we know how it works. GST is a single unified indirect tax that replaced multiple central and state taxes in India. It is a consumption based tax, meaning it is levied at the point of consumption rather the production. It follows the principle of one nation and one tax. So what are the key features here? Comprehensive. It covers almost all goods and services, which makes it comprehensive. Multi-stage, levied at each stage of supply chain. It can be such as during manufacturing, during the wholesale stage, wholesale purchase, and at the retail stage. So different stages. Destination based. Tax accrues to the state where the goods or services are consumed, not where they are produced. So consumed, okay, where they are consumed, that place is where the taxes are put in, not where they are produced. VAT, value added tax principle, like it is taxes only on the value added at each stage, preventing cascading, that is tax on tax, through the input tax credit mechanism. Dual GST model. India adopted the GST dual GST model, which means both the central and state government simultaneously levy tax on the same transaction. Like we can see, such as SGST, CGST, IGST, UTGST. See, these are few examples where the central and the states levy on the taxes. So, what are the benefits of GST, goods and services tax? For business, it reduces the cascading effect, that is tax on tax, which through seamless input tax credit, which leads to lower tax burden. Easier compliance, simpler and fewer returns compared to the multitude of taxes previously. In earlier times, when the VAT and when other taxes were there, the taxes were very complex, but it has brought in easier for the business in particular, so that it is easily done and easily taxes are paid. Creation of national market, free movement of goods and services across state without entry taxes promote efficient supply chain and reduced logistics costs. Rationalization of warehouses and supply chains, which reduces the logistics costs as well. Now, for consumers, it potentially lowers the prices because due to the elimination of cascading, the final burden on consumers might reduce over time, though the initial impact varied. Next one is transparency. Clearer tax structure. GST has clear tax structure, which makes it more benefit for the consumers to use it well. For government, higher revenue buoyancy, which means expected to increase the tax revenue collection in the long run as compliance improves and the tax base expands. Simplified administration. See, streamlined tax administration in GST helps so people to help the people to know step by step, and it will also help the government to scrutinize and work on the administration properly. Next one is boost to GDP. Expected to boost India's GDP in the long run by improving the efficiency and reducing the cost. So what is now? We are done with GST. Now, what is this tax revenue? See, government revenue, the revenue of government is usually categorized into two: tax revenue and non-tax revenue. Income generated by government through taxes imposed on individuals or businesses is called tax revenue, and it forms the largest component of the government revenue. Direct taxes like income tax, corporate tax, capital gains tax, STT, CTT, they are all direct taxes, while indirect tax like GST and customs duty are indirect taxes. See, what they do is like it helps in long term growth. Okay, this tax revenue helps in long term growth, for proper formalization of economy, and also detect the tax evasion. So, while non-tax revenue is income generated by the government from sources other than taxes, like components include interest receipts, interest earned on loans given by the central governments to states, union territories, on public sector undertakings, that is interest from the loans provided by central government to other states, union territories or public sector undertakings. Dividends and profits. Dividends received from the public sector enterprises and profits of the government owned financial institutions such as RBI profits, or even recently we saw about SBI dividend. So these are some aspects. External grants. grants received from foreign countries or international organizations. So, such as World Bank, Asian Development Bank, IMF, they are all external grants. This investment reports proceeds from the sale of the government equity in public sector enterprises. So it might be called a capital receipt also technically, but it's also discussed alongside the revenue for overall fiscal health as well. Along with these components, we can add some miscellaneous receipts. You might ask me what these holds: fines, penalties. They all come under miscellaneous reports. So, while significantly smaller than tax revenue, non-tax revenue also plays a vital role in funding the government expenditure. It reflects the government's role as a service provider, regulator, and owner of assets as well. So, with this, we are done with today's lecture, guys, on taxation. The detailed notes will be put in the Telegram channel wherein you can refer and get ready for prelims and mains as well. So do watch the lecture entirely, do watch the series entirely in particular, and get to know about the concepts and topics as well. So keep supporting, and we'll resume with the next lecture soon. Thank you.